You should have put my money on deposit with the bankers so that when I returned, I would have received it back with interest. What's up, world? Today we're talking about creating your own banking system through dividend-paying life insurance. Run the intro.
Caught up in them bright lights, lusting for shiny things that's golden. Everything ain't always what it seems, let it soak in. Chasing my dreams, coming apart at my seams. Best believe that the money is the motive.
All right. Welcome back to another episode of the MITM podcast. And today we're back with the Infinite Banking book, and we're going to talk about creating your own bank through dividend-paying life insurance. Okay. Now, this is honestly one of the coolest things that I know about, and I think that today we're going to get a lot. So let's just hop into it. Banking, the business of a bank. Originally restricted to money changing and now devoted to taking money on deposit, subject to check or draft, loaning money and credit, and any other associated form of generally dealing in money or credit. Webster's Third New International Dictionary. The very first principle that must be understood is that you finance everything that you buy. You either pay interest to someone else or you give up interest you could have earned otherwise. The alternate use of money must always be reckoned with. Some call this opportunity cost. But it is amazing how many people give lip service to this fact, but do not put it into practice in their own financial dealings. The equivalent of thinking that the law of gravity applies to everyone else but them. An excellent article appeared in the September 1993 issue of Fortune magazine entitled The Real Key to Creating Wealth by Sean Tooley, in which he described the concept of economic value added, EVA. And this developed by Stern, Stewart, and Co. of the New York City. Tully said, understanding that while EVA is easily today's leading idea in the corporate finance and one of the most talked about in business, is far from the newest. On the contrary, earning more than the cost of capital is about the oldest idea of enterprise. But just as Greece's glories were forgotten in the Dark Ages to be rediscovered in the Renaissance, so the idea behind EVA has often been lost in the dark forever muddles of accounting. Managers and investors who come upon it act as if they've seen a revelation. In summary, before being introduced to EVA, corporations were borrowing capital from banks and paying interest, but they were treating their own capital equity as if it had no cost. When they were brought face to face with the error of their ways and conducted their business with the facts included on the equation, then the profitability increased dramatically. EVA's basic premise is, if you know what's really happening, you'll know what to do. The same concept applies to the infinite banking concept. In creating any product, it all begins with engineering. The automobile you drive started out being lines on a piece of paper. If the production workers don't do what the engineers designed, you won't have the automobile. But they did, and your car rolls off the assembly line. Suppose that I get the next one and it's identical to yours. Same color, equipment, features, etc. They are identical in every way. Can you safely predict that they will both perform identically during their lifetime? Of course not. Because you and I know someone that can get 200 to 300,000 miles out of a car with no trouble, but we both know someone that can't get 50,000 miles out of their car before it's worn out. How do you drive the car and care for it is far more important than anything else. Keep this thought in mind as we look further at life insurance products. The engineers of life insurance are known as actuaries. They're dealing with the field of 10 million selective lives and persons that have been through a screening process. And they're working with theoretical lifespan of 100 years. Then they turn their information over to the rate makers, who determine what the company is going to have to charge its clients in order to be able to pay the death claims and make the whole system work over a long period of time. Okay? Then the whole matter is turned over to the lawyers, who make legal and binding contracts that are to be offered to potential buyers through a sales force. The glue that holds this all together is comprised of the administrative folks, executives, clerks, etc. The contract is unilateral. That is, the company promises to do a certain thing if you meet the standards of acceptability and make premium payments. Read the contract and it will tell you very plainly that you're the owner of the contract, not the company. The owner is the most important character in this scene. Now, to make the plan work, the owner must make payments into it, and the company, the hired help, must put the money to work in order to produce the benefits that are promised. Those with the investment responsibility will do so in a number of ways. In financial instruments that are fairly conservative, like for example bonds, mortgages, etc. Look at the investment portfolio of a number of life insurance companies and you'll see what I mean. One place that is speculative that some companies do invest in is real estate developments and joint ventures with other private organizations. Some large developments of urban office buildings have been entirely financed by a single insurance company. This can often include shopping centers. But upon reading the contract, the policy, you'll find that it plainly states that the owner outranks every potential borrower in access to the money that must be lent. And what he can borrow is 100% of his equity in the contract, the amount that the company can lend at any one time. If this is true, which it is, then what this amount to is absolute control over the investment function of the company as it relates to the owner's policy. In essence, money can be lent to the other places only if the owner of the policy does not exercise his option to use the money and pay interest instead. As a result of foregoing, there is an ever-increasing pool of money. From time to time, an insured person dies. It doesn't happen very often, but when it does, the company pays the beneficiary from the pool of money, and the cost of doing so is allocated among the policy owners on an equitable basis. The hired help, the administrators, must be paid for their work too. You can't just run a business without hired help. Just try to do it and see what happens. Your competitors that know better will run you out of business. This cost is also prorated among the policy owners too. At the end of the year, the directors that actually run the company call the accountants and in essence ask them, how do we do this year on John Doe's policy in comparison with the assumptions made by the actuaries and the rate makers in designing it? We must digress at this point and remember that the actuary is a kind of engineer and that all engineers overbuild everything they designed. If he doesn't think so, he wouldn't be an engineer very long. I think about this every time I get in the cockpit of an airplane. I've never seen an instrument panel that does not include an airspeed indicator with a red mark somewhere on the face of it. It's telling you don't go past this point or the airplane will come apart and on you, resulting in rapid loss of control and imminent death to all occupants, or something to that effect. That is not true. It won't come apart until the airspeed is some 20 to 30% greater than the red mark. The engineers have put a fudge factor into the equation, but if you operate the airplane just beyond the red lines on a regular basis, you're putting stress on the wings, etc. that are cumulative in their effect, and one of these days, you're going to reap the rewards of your actions, and it will not be a pretty sight. Speaking of engineers, this is a mindset that I like to hold on to and to maintain with anything that we build. Any event that we do, any retreat that's built, any product that's created, the goal is to over-engineer it to make sure that when the worst possible thing happens, we're still safe. You have to create your investments and your plans with a certain margin of errors to ensure safety for yourself and others. Back to the book. Furthermore, the policy is engineered to become more efficient every year no matter what happens. That is, if the owner does what is called for in the premium paying loan repayment plus interest theory on that are at least equal to or better than the general investment portfolio of the company. That is because the cash value is guaranteed to ultimately reach the face amount of the policy by age 100 of the insured. There's an ever-decreasing net amount at risk for the company. Not too many people are familiar with the concept of getting better no matter what. So let's look at the airplane world, for example. Imagine that we're going to make a very long flight in a Boeing 747. So we load it with all the fuel that it'll hold. This makes it capable of flying about 10,000 miles. By the time we fly 8,000 miles, the airplane will be able to do things that it would never attempt at takeoff. This is because we've burned up an enormous quantity of fuel and the airplane weighs that much less. But the engines are capable of producing as much power as when they took off. Therefore, every mile that we fly, the airplane will get more efficient. And you can't do a thing about it. It gets better no matter what. In designing the life insurance policy, the rate makers have to take into consideration the advice of the actuaries that their assumptions are not set in concrete. They include the interest earnings on the premiums paid by policy owners, the death claims expected during the time frame, and the expected cost of administration over a long period of time. The actuaries can be pretty accurate with this, but from time to time, the results can be better or worse than predicted. There are variations in interest earnings, death claims, and expenses of operations, and these factors affect the dividend scale declared for the coming year. You can safely say that the real results will never exactly match the illustration provided at the beginning of the life policy. But once a dividend is declared, its value is guaranteed from that point on. It can never lose value in the future, as can the value of the securities. It has always been a mystery to me. Why do they call stocks securities when it's possible to lose their value entirely? It all sounds like an oxymoron. Maybe it's like Social Security, which has no market value at all. A significant period of lower than expected earnings of interest or period of more than expected death claims and or administrative expenses can result in a downer for the company. When this happens in a regular corporation, it's a function of the stockholders to take up the slack. But in this case, the rate makers are reminded that we don't have any stockholders. So the rate makers are cautioned by the actuaries that if we calculate that would require $1 per year for a given plan, don't collect $1.10. This extra 10 is the capital that makes the whole system viable. Now, back to our scene on John Doe's policy. He has had it for a few years, and the directors have asked the accountants, how do we do on John Doe's policy this year? The accountants report that he's collected $1.10, but after calculating all the aforementioned cost factors, they found out that it only took 80 cents to deliver that promised death benefit for the future. This means the directors can now make a decision with 30 cents. If they're halfway smart, and most of them are, they'll take into consideration that they need to put a part of this into a contingency fund to prepare for unexpected future risks. So they put 0.025 into the contingency fund and distribute 27.5 cents and call it a dividend. Most people have the impression that this is a taxable event. This is not so. Remember that the income tax has only been with us since 1913. That's for the US. I know y'all are listening in Canada. But life insurance has been around for over 200 years. The word dividend was used by the insurance industry to describe its dispersal, and it stuck with us. But the correct classification is a return of premium or a return of capital. If the owner uses a dividend to purchase additional paid-up insurance, no cost for acquisition, sales, commissions, etc., the result is an ever-increasing tax-deferred accumulation of cash values that supports an ever-increasing death benefit. And there are no government bureaucrats looking over your shoulder telling you what you can and cannot do. The result is limited only by the imagination of the policy owner. By the way, these dividends can get pretty significant over a long period of time. For example, Nelson here bought a policy from a major insurance company in 1957, and the annual dividend is over 10 times the annual premium now. They'd been much larger had he not used the annual dividend to reduce premiums for the first 15 years. These things are not adequately explained by life insurance sales folks because of the limited understanding of their home office folks that teach them. So far, this is pretty simple stuff. Now for the complicated part. The life insurance salesperson calls on my all-American young man referred to and earlier in this book, making about just under $30,000 per year, and urges him to consider how much the world is going to miss you in the case of your untimely death. So he calculates his human life value by asking how much he expects to earn per year as an average and multiplies that by the number of years he's expected to work, assuming he lives that long, assuming that he'll get pay raises from time to time. It's reasonable that his average annual income increases something like $38,000 times 36 years until age 65, which will produce $1.368 million in income. The insurance agent points out that he'll use up something like 40% of this income stream to support his own needs. This means that $820,000 in income for his family, and the charities he holds dear will vanish if he happens to die in the near future. To arrive at a principal sum, the capital that would be required to produce that income stream, this figure must be discounted at a nominal rate of interest. The agent says, so if we're able to buy a machine that would produce that income to your family, we'd have to pay about $400,000 cash for the machine now. That's how valuable you are to them and your charities, Mr. Doe. If you own such a machine and it was subject to sudden loss of some kind, would you insure it? Mr. Doe says, I believe this is the last. So this is where Mr. Doe would say, yeah, by all means, I need that. And you say, how much would you insure it for? Well, this machine, you'd insure it for $400,000. And the agent would then say, now that we have that established, let me show you how little you'll have to pay my company to satisfy this need. So we're going to get $400,000 of value of a machine to cover $800,000 difference, giving us about, on average, $1.3 million in cash for the rest of our earning years. And honestly, like, to earn only $1.3 million, we're going to be doing a lot more, guys, because we're the MITM club over here. But if you take an honest look at what this young man is now doing, he's paying over 35% of every dollar of after-tax income to interest alone. It should be obvious that his needs for finance is much greater than his need for life insurance protection. If he would solve for the need of finance through dividend-paying life insurance, he would automatically have much more life insurance and recover all the interest he's now paying to someone else. But this almost never occurs because of the mental block implanted by the financial geniuses that life insurance is a poor place to store money. What a limited outlook of just what is going on in the banking world. Again, I remind you, if you know what's really happening, you know what to do. And so the young man puts $50 per month into a life insurance premium and feels that he's insurance poor, but he's worth more dead than alive. Then he goes down to the dealer and buys an automobile, paying for it with a loan from the bank. Remember that there's only one pool of money in the world. The fact that any number of organization or individual are managing a portion of the pool is incidental. But it can be even more specific when it comes to automobile loans. Man, don't get me started on automobile loans. Heck, the rest of this thing is this guy explaining automobile loans, but I can just talk on this myself, okay? Because this is just, I'm gonna skip over what he's saying for the automobiles, and we'll jump back into some of the other principles of the infinite banking. But y'all definitely got to pick up this book, okay? This book is absolutely amazing. There's so many gems in here, okay? It really shifts the way that I see finances and the way that I've been experiencing them. And for automobile loans, for car loans, I bought a $20,000 car for $28,000, okay? First time buying a car from the dealer. Worst experience I've ever had. I got a $20,000 car for $28,000 because they added on all this bullshit that I didn't need. Okay, I didn't need any of it, and I didn't know what it was. Okay, and in the last 5 years, I spent $26,000 on this car. You would think that I'd be done paying for this car, but I still owe $21,000 on this car. How? The example that he says here is that 35% of every dollar he goes to spend on this car loan goes to interest. Okay. Actually, you know what? Let me hop back into this because the way he explains it is so on point, and the way that I'm so angry about this, it's literally the same amount that I was spending on my car, but worse off. Okay. This man pays $260 per month for a minimum of 48 months for his $10,000 car loan. I was doing $226 bi-weekly. Okay. He does this throughout life because that's the way what all his peers are doing. If he would take time out, stand back far enough to get some perspective, he might notice that he's paying $50 per month into a pool of money for his life insurance policy, but he's paying $260 to an intermediary, the finance company that deducts a fee and lives well off the activity, which passes the residual sum back to the same pool of money. Okay, it's going to the same place at the end of the day, but you're giving it to the bank instead. Ridiculous. So he complains about the premium he pays, but thinks nothing of the much larger amount he pays to the automobile financing company. It's strange. In the above example, he's paying a total of $310 into the pool, $50 directly and $260 indirectly. If he can muster up the courage to pay $310 directly into his insurance policy in the form of premiums for around 4 years, he can now make a policy loan and pay cash for the automobile. Here comes the important part again, so pay close attention to this. The insurance agent now needs to make him vividly aware that he must pay the loan back at an interest rate that is least equivalent to the going rate of an automobile finance company, not what the policy calls for. In this case, it should be at least $260 per month. If the policyholder does this, then he will effectively make what the finance company would otherwise make and do it all on a tax-free basis. If the agent is really good and understands the principles of banking, he'll encourage the policyholder to pay $270 per month because the extra dollars will go to his policy to increase the capital that can be lent to other parties. If the policyholder objects that it's my own money and I'm not going to pay any interest at all, or maybe I'm only going to pay 2.9 as seen on television commercials, the agent must send him back to the grocery store at the beginning of this book and explain to him one more time. If he still doesn't understand, then the agent needs to have him revisit the story of the failure of the First National Bank in Midland, Texas. If he still doesn't understand, the agent needs to resign from working with him because he's not teachable and or he's a thief. Neither of these characters are desirable business associates. You have now had an explanation of all the essential principles of banking through the use of dividend-paying life insurance. But to understand the infinite qualities of the infinite banking concept requires a deeper look. Okay? In the above examples of the car financing, the capitalization needs to be somewhat greater than just 4 years. Many college business professors estimate that corporations expect it to take at least 7 years to get back profit from a new investment. This is an understatement in certain undertakings, so why not capitalize each policy purchase for at least 7 years, to the point where dividends will pay all the remaining premiums on the policy. This will be explained in detail later in the book. Would you have much of a grocery business if you were the only customer? You must build it to the point where you can accommodate the needs of others in order to prosper. The same principle applies to banking. Furthermore, I'm not describing one life insurance policy. This is to be a system of policies. Have you not noticed that when a grocery store becomes successful in one location, then it tends to establish another store in another location? Have you not noticed that banks have branch offices? There must be a reason for their behavior. Then why not expand your own potential by buying all the life insurance on yourself that the companies will issue, and then on all the persons in which you have an insurable interest? At present, does not all your income go through the books of some bank? Don't the banks lend out the deposits to customers? All they do is capitalize the bank to make it a safe place for customers to deposit their money, and then lend out the money left in the deposits. If they don't lend the money out, they'll go out of business. It'll take the average person at least 20 to 25 years to build a banking system through life insurance and accommodate all his own needs for finance, his autos, house, etc. But once such a system is established, it can be passed on to future generations as long as they can be taught how the system works and suppress their baser instincts to go out the back door of the grocery store. Or, in other words, steal. Okay? So that is this chapter of the infinite banking concept. That was like 3 pages talking about creating your own banking system through dividend-paying life insurance. Okay, this is what I've literally been doing. This is what I'm teaching my clients to do. This is what I'm so grateful to have the opportunity, the space, the wherewithal, the knowledge to be able to say, hey guys, come over here. Let me show you something dope. Let's make some money and let's make a change in some people's lives. You know? Anyways, that's it for this episode of the MITM podcast. Make sure you guys check out the link in the bio for the 5-day FBC challenge. I want to help you master your money in 5 days. Like, what is base camp even? Base camp is the place you go to before you go up the mountain. Okay? And I want to help you scale that mountain. I will carry you on my back up the mountain. We're going to do this together. All right? So that being said, I will see you tomorrow. Peace.
Give them that creme de la creme whenever I spit that hot shit. Ain't no lose or draw when it's the only option. Till I'm balling like Stockton, I'm locked in. Researching the best stock tips, fuck gossip unless it makes a profit.